It's no secret that shipping rates have exploded, then come back down to reality in the last 3 years. If you're following ZIM stock, you probably know that the company benefits from higher shipping rates. So now that shipping rates have collapsed, how is ZIM reacting to the decreasing market conditions? Well, that's what I'm going to talk about in this video is ZIM's reaction to the terrible market conditions it finds itself in after it found itself in really good market position a couple of years ago. So let's get right into the details. So the CFO of the company was responding to this exact question from an analyst that was asking it this precise question. How are you guys reacting to the state of the market right now? And the CFO said, you know what? We do realize that things are very different than they were 2 years ago, and we are making changes. So first, we're making sure we deploy our capacity where it makes more sense. We're not having our ships in areas that it doesn't make sense to have us in. We're not operating in areas it doesn't make sense for us to be in, right? That's the start of it. So we exited or suspended our operations between Asia to the US West Coast, right? Because that was a very popular trade route during the earlier parts of the pandemic when citizens in the US were buying a lot of goods made in Asia. And so that was really popular. Now, that's not the case. So it's good to see them canceling those routes. To the southwest coast, the service that we had between South China and LA is a service that we suspended due to the significant rate erosion that we experienced on those trades. Now, I had been following the rates on this route along that time, and it had exploded nearly 10 times higher on this specific trade route during the peak of the pandemic, and it has come back down to where it was nearly before that explosion happened. So ZIM saw its rates go up 10x and then come back down 10x on this route. And so now they're repositioning that capacity and upside their service between Asia to Australia, which now is a more lucrative trade route for ZIM. So they're moving around their ships, right? So they've got something they can do about it, and they are doing whatever it is that they can do. And they also opened a new line between the south, so the west coast of South America, and towards the east coast of North America. So changing where they have their allocation, and I suspect this will be a more lucrative route for at least the next few quarters. Folks in the US, they bought a lot of goods during the earlier stages of the pandemic. Think about how many people bought TVs, computers, tablets, couches, washing and laundry machines, refrigerators, things that are long lasting goods that they're probably not going to buy again for several years. Now multiply that across the entire US population. There was a lot of long lasting goods purchased during 2020 and 2021, fueled by the fact that people couldn't spend money on dining out, on entertainment outside the home. Plus, they had stimulus money, so they had more money to spend, fewer places to spend it. So there was a lot of things that they bought that were long lasting goods, and they're not going to need to replace these things for several years. So that means trade imports from China to the US is going to be muted for the foreseeable future, at least for the next few quarters, until those replacement cycles start to play in, right? For instance, for computers, it's about a 4 to 6 year replacement cycle. So people who bought computers in 2020, they're gonna need to replace them starting 2024. So at least that part of the trade can rebound. But other areas might be longer lasting, and so trade is going to be muted for some time, and ZIM is making adjustments to accommodate for those changing conditions. Also, they took deciding actions a couple of years ago. They now have an order book in terms of more efficient tonnage. So this is a priority for them to make room for the more efficient tonnage that's coming online. Interestingly, they have 17 vessels that come in for renewal now and at the end of the year, and another 37 next year. So that's 17 ships that they don't have to renew their contract with, and then 37 again next year. And so if the market remains the way it is now, which is not very strong, we can deliver most of that capacity, turn it in, right? Not renew those leases, so they can make room for the newer, more efficient tonnage that's expected to come their way. So they can replace older, less efficient ships with newer, more efficient ships. So when the market does eventually reach an equilibrium, the company will be more profitable because its cost of goods sold, its cost of service will have decreased. So it's good to see the company is taking steps, making improvements, doing what it can, even in this very tough operating environment for ZIM stock. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.